Very good afternoon and welcome to all the financial enthusiasts for this yet another wonderful session for pediatricians. So we have a eminent speaker today who is a taxation and investment expert and who is a chartered accountant by profession and is a company secretary also. So we have a very renowned Balwant Jain sir with us today to discuss about taxation for the doctors. Sir has given many shows on the TV and many renowned famous TV chats and all, and he has featured many articles in the top newspapers of India. So we welcome Balwant Jain sir for sparing his Sunday afternoon for educating all the doctors regarding the taxation. So thank you so much, sir.
Thank you. My pleasure.
So now, without wasting much time, I request Balwant Jain sir to initiate this program. And as we all know that this program, this financial fitness program for the pediatricians is being started by Indian Academy of Pediatrics, Telangana State Branch. And we are following the same for the past 2 years. And Balwant Jain sir is the one strongest pillar, I can say, who is there since the beginning of this program. And initial days, that certification, 8-week certification program from IAP PATS was the first speaker in that. So we welcome you, sir, with a great renowned respect, and we are ever grateful to you for accepting us, for educating all the pediatricians in our group, who are more than 1,020. So with that, I request Balwant Jain sir to start your session.
Thank you. Thank you, Dr. Pawan. Thanks the organization for inviting me and all the present doctor for attending it. There are no specific provisions for taxation of doctors under the income tax law, except for a requirement to maintain books of accounts, which a doctor is required to maintain. So I was under dilemma what to cover, what not to cover. So I decided I will cover capital gain, because this is very important and current topic for all the doctors. All the doctors invest their surplus money either in real estate or in equity, mutual fund, direct equity, etc. So first, I intend to cover capital gains provision, major provisions, because the capital gain chapter itself is very wide. Next, later on, I will cover the hot topic, hot cake, old and new tax regime. Can the organization please put the other people?
Yes, sir. I have muted all, sir. Now you can open and talk, sir. Sir, please unmute yourself, sir. I made you co-host, sir.
Okay, I have unmuted. Okay. Next, I will cover presumptive scheme of taxation for some certain specified professions, which include doctors. And then I will discuss the lower or lesser important chapter, which doctors are not bothered, but the law requires the doctors to maintain their books of accounts under certain circumstances and get them audited. So, first, I will take up taxation of capital gain. To start with this taxation of capital gain part, first I intend to cover the taxation laws which are applicable to listed shares and equity-oriented schemes. So what are listed shares? Listed shares are defined the shares of Indian companies which are listed in Indian stock exchanges. So if a specific share is listed on foreign exchange and not in India, it does not qualify as a listed share. and the other equity schemes, which are called equity-oriented schemes, which are required to invest minimum of 65% of their investable fund in Indian listed companies. So these two categories of investments are covered under the present discussion. So your listed shares and equity-oriented schemes become long-term after you have held them for 1 year or more. So, where I'm getting this voice disturbing. So once you hold these shares for 1 year, the investment becomes long term, and whenever you redeem those shares or sell those shares or redeem those schemes and sell those shares, a flat rate of 10% is applied on the long-term capital gain after initial 1 lakh, which gets taxed at a 0 rate. So and no indexation benefit is allowed, though the profits are treated as a long-term, and generally for all long-term capital gains, you are allowed to apply the indexation, but not in respect of listed shares and equity-oriented schemes. Income tax law allows a rebate under Section 87A if you opt for old tax regime. The threshold limit is 5 lakh, and if you opt for new tax regime, the threshold limit is 7 lakh. So if your income does not exceed 5 lakh or 7 lakh respectively, you get a tax rebate against your tax liability up to 12,500 under old tax regime and 25,000 under new tax regime. All for you are eligible to claim this tax regime against all tax liability except the long-term capital gain in respect of listed share and equity-oriented schemes. In case of this long-term capital gain, you can invest in a residential house and claim exemption. We will discuss Section 54 in detail later on. And in case you dispose of those shares or the equity-oriented schemes within 12 months, the profits are treated as short-term capital gain, and this short-term capital gain is taxed at a flat rate of 15% against other short category of short-term capital gain, which are treated like your regular income and included in and taxed at your slab rate. In respect of capital gain under Section 112A, which we are discussing, you are not allowed to claim any deduction under Chapter 6A, which include popular section like Section ATC for PPF, LIP, ELS, etc. Likewise, if you are a resident and your other income is less than lower than the basic exemption limit, then you are allowed to set off your that shortfall in the basic exemption income to the extent of short-term against your short-term capital gain and long-term capital gain in respect of listed shares and equity schemes. The next category is of unlisted shares or foreign listed shares. As I said, the shares which are listed on foreign stock exchanges are not treated as a listed shares for income tax purposes, and the unlisted shares, in case you have made investment in a company which runs a hospital, or for that matter any other investment in a company which is not listed, this itself constitutes a separate category, and here your investment becomes long term after completion of 24 months. So before 24 months, the profits are treated as short-term capital gain and taxed at the regular rate. The tax in respect of long-term capital gain on unlisted share and foreign equity shares, is it flat 20%, but you are allowed to claim indexation benefit. Section 54F I will discuss later on. Likewise, as explained earlier, in case of any shortfall in the basic exemption, you are allowed to adjust the long-term capital gain against short-term against this long-term capital gain. You can adjust against the shortfall in your basic exemption income. Mind it, such a setup is not allowed to non-resident, and the non-residents have to pay tax at the flat rate, either 10% or 20% on long-term capital gain and 15% on short-term capital gain on listed shares and equity-oriented schemes. As I said, the rebate under Section 87A in respect of your tax liability is available against all short-term capital gain and long-term capital gain, except that long-term capital gain in respect of listed shares and equity-oriented scheme. You cannot claim any deduction under Section 80C, 80D, 80TTA, 80TDB. These are commonly included under Chapter 6A against the long-term capital gain, any long-term capital gain or short-term capital gain on listed shares. But you are allowed to adjust the short-term capital gain or claim deduction under Chapter 6A for a PPF contribution, ELS, etc., against the short-term capital gain of all other category except the listed shares and equity-oriented schemes. Let us now come to mutual fund taxation, a specific mutual fund taxation where the equity proportion is less than 65%. The budget 2023 has amended the provision drastically in respect of non-equity oriented scheme, mutual fund scheme taxation. So they have created one more category of mutual fund where the domestic equity component does not exceed, is up to 35, does not exceed 35%. So in all such investment where the domestic equity does not exceed 35%, any profit made on such investment will be treated as short-term and included in your regular income and taxed at your slab rate irrespective of holding period. So now these are placed on par with the fixed deposits. This would include all gold ETF, gold funds, gold saving funds, silver funds, bond funds, GSEC funds, all for that matter, all even the foreign mutual funds also, where the Indian equity is less than 35%. So you have to pay tax from the on this income at the rate applicable to your slab rate. Though this taxation of this special category has been brought on par with fixed deposit, but in case of fixed deposit, the interest becomes taxable on accrual basis or on receipt basis, whether you follow cash basis of accounting or mercantile basis of accounting, which we will understand later. But investment in your mutual fund gets taxed only and only when you redeem your investment and not before that. I will not repeat the 87A rebate, etc., because 87A rebate in respect of your tax liability is available for all your tax liability except tax liability in respect of listed shares and equity schemes. SEBI, since the Income Tax Act, this budget has been passed 1 month back only. So SEBI is here to come out with a corresponding category where the equity investment does not exceed 35%. The third category of mutual fund are the mutual fund which have a equity in domestic equity investment of more than 35%, but does not exceed 65%. If it exceeds 65%, then that category becomes equity oriented scheme. So this is the third category, or it is the rather the old category. One category of 35% has been carved out. So this the old provision in respect of debt fund or non-equity fund continue to apply to this residual category, where the investment becomes long-term after 36 months. You are allowed to have indexation benefit. In long-term capital gain gets taxed at 20% after indexation. Non-resident, as I said, are not allowed to set up the shortfall in basic exemption, whereas the resident taxpayer can set up the shortfall in basic exemption. This is the repetitive feature of in respect of all long-term capital gains and short-term capital gain on equity. Now let us take the long-term capital gain on immovable property. I've observed lots of doctors make significant investment in real estate. So I thought it proper to include the immovable part of long-term capital gain also in our discussion. So I will cover the investment in land and building, which become long-term after 24 months, and you are allowed to apply the indexation benefit, and after indexation you have to pay 20% tax. 87A rebate is available here. The chapter 6 ATC, ATD, ATDD, the ATCCD 1B, etc. are not available. Short-term capital, if the property is sold within 24 months, the profits are treated as short-term capital gain and are taxed at slab rate without any indexation benefit. Not able to move. There are certain exemptions which are available in respect of long-term capital gain. So there are basically 3 sections which grant you exemption from payment of tax on your long-term capital gains. The first is section 54. Section 54 applies where you sell a residential house and buy a residential house within a period of 2 years, or get a book an under construction house, residential house within a period of 3 years. Even if you had bought a residential house within 1 year prior to sale of this residential house, you can claim exemption under section 54. The exemption is available. For availing the exemption, you only have to invest the capital gains after applying the benefit of indexation. So there is a difference between section 54 and 54F, which we will discuss later. So from sale, capital gain from sale of one residential house, you are required to buy one residential house. So you cannot, generally you are not allowed to invest capital gain from sale of one residential house in 2 residential house, except a one-time exception is allowed, where you are allowed to invest your long-term capital gain from sale of one house for purchase or construction of 2 houses, provided the index capital gain does not exceed 2 crore in aggregate. And this benefit can be availed only once in a lifetime. This budget has put a cap on the maximum amount which you can invest in a house. So earlier there was no limit for availing section 54 exemption, and you could sell a house property of 100 crore and making a gain of anything between 50 crore or 70 crore, and you could have invested those 50-70 crore in buying another residential house, and the transaction would be tax-free for you. But from this budget, from the current financial year, the investment beyond 10 crore rupee will be ignored. So under section 54, you will be able to claim maximum capital gain exemption of 10 crore and not beyond. The next, you are required to invest the money in the specified period of 2 years in case of ready to move in house and 3 years in case you get an under construction house. So, but in case you are not able to utilize the money by due date of filing of the income tax return, you are required to make deposit of the unutilized portion in a capital gain account scheme with a scheduled bank. The next exemption is available is under section 54F. So section 54 applies in respect of long-term capital gain arising from sale of a residential house. And section 54F deals with all the capital gains arising from sale of all the assets except the residential house. So in case you sell your dispensary or sell your investments in listed shares or shares investment in a hospital project, you can claim exemption under section 54. But to claim exemption under section 54, you are required to invest the sale proceeds as against the capital gain, index capital gain in case of a section 54 for a capital gain on a residential house. So you have to invest the net sale proceeds from this year, like for section 54, for section 54 also, investment cap of 10 crore has been enacted by the budget 2023. For availing section 54, the law requires that you should not be in possession of a more than one residential house on the date of sale of the asset against which you wish to claim section 54F. And like the exemption under 54, even if you are not able to invest the money by the due date of filing of your return, you have to deposit the money in a bank capital gain account scheme. A question may arise whether one can claim the exemption under section 54 and 54 at the same time, means in respect of investment being made in a residential house. So suppose you have sold a residential house, you have sold a commercial property also, and you want to buy a bigger residential house. And for a residential house, you can claim exemption under section 54. For a commercial property, you can claim exemption under 54F. So yes, you can claim simultaneously under both the section in respect of investment being made in a single house. The next exemption is available under section 54EC, which is available to everybody, individual HUF and even the company taxpayer also, whereas the section 54 and 54 exemptions are available only to individual and HUF. The section 54 EC exemption is available in respect of long-term capital gain arising on sale of land and or building. Here, you have to invest the indexed capital gains in capital gains bonds of specified financial institutions like National Highway Authority, Power Finance Corporation, Rural Electrification Corporation, etc. The investment, as I said, has to be made within 6 months. There is a limit, overall limit of 50 lakhs, beyond which you cannot claim the exemption in respect of a single financial year, and you cannot make investment of more than 50 lakhs in one financial year. So that was the capital gains. In case the viewers have any query, they can ask at the end of the session. Now let us come to that confusion about the old tax regime and new tax regime. So I need not elaborate on what is old tax regime and new tax regime, because by now, since it was introduced in budget 2021, almost everybody is aware that new tax regime is where you are not allowed to claim lots of deductions and exemptions, etc. Till last year, means the financial year 22-23, the old tax regime was the default tax regime. But from this financial year, they have changed the default tax regime. And now the new tax regime is the default tax regime. So in case you do not exercise the option before the due date of filing of your income tax return, the default tax regime is only available to you, and you cannot avail the old tax regime for the current financial year, for which you will be filing your income tax return in July 24. The scheme applies to all the individuals, HUF, AOP, and body of individuals. There are certain benefits which are not available under the new tax regime. All the deductions under Chapter 6A are like Section 80C, 80CCD in respect of your own NPS contribution, 80D in respect of Mediclaim policy, 80G in respect of donations, saving bank account, etc. Those are not available. In case you are salaried, you are allowed to claim exemption in respect of certain allowances which are exempt. Major are HRA, house rent allowance, and leave travel assistance. So in case you opt for a new tax regime, you cannot claim these two major allowances. However, for salaried, the standard deduction and the employer's contribution is available under both the tax regime, old and new. In respect of self-occupied property, if you have taken home loan or borrowed any money, if you opt for a new tax regime, even the interest which you pay for your self-occupied property, which is restricted, which is available up to 2 lakh, which is not available. In respect of let out property which you have, which you own and which you have let out on rent, you are presently, if you opt for old tax regime, you can claim, you can set off loss under the house property income up to 2 lakhs against your other income. But if you opt for new tax regime, though you can claim the interest, but only to the extent of a rent payable. Beyond that, in case if it results in a loss, you are not allowed to set up that loss against your other income. The difference between the old and tax regime, the old tax regime, there are tax slabs 2.5 lakh to 5 lakh 5%, then 20%, and 20% 5 lakh to 10 lakh, and beyond 10 lakh 30%. For a new tax regime, they have a different tax slab. So against the 2.5 lakh basic exemption under the old tax regime, for people who are below 60, under the tax regime, the basic exemption limit is 3 lakh, is set at 3 lakh for everybody. Between 3 lakh and then there are slab changing with every 3 lakh of income. So between 3 and 6 lakh, it is 5%, then 6 to 9, 10%, 9 to 12, 15%, 12 to 15, 20%. Then over 15 lakh, 30% rate applies under both the regime, new tax regime and old tax regime. One major difference which has been introduced in this budget to make the new tax regime more attractive is enhancing the threshold limit for rebate under section 87A, which I have explained earlier. So if you opt for new tax regime, the threshold will be 7 lakhs. So if you opt for new tax regime, you will get a tax rebate up to 25,000, provided your income does not exceed 7 lakh. But the threshold for old tax regime has been for 87A has been retained at 5 lakh only. There is a concept of marginal relief under the income tax law, where in case due to higher tax rate results into more tax liability than the marginal income, the law provides that your marginal tax, the differential tax, shall not exceed the income which exceeds the limit, the limit beyond due to which the tax has gone up. So in case the marginal tax relief is being made available to those who opt for new tax regime. So once you cross the limit of 7 lakh 10 rupee, your tax, you will have to pay 25,000 plus 10% on 10 rupee. So just for incremental income of 10 rupee, you will have to pay 25,000 10 rupee. So that the new tax regime has provided that in such cases, the additional tax liability shall not exceed the additional income. So in this case, your tax liability will be restricted to 10 rupees and not 25,010, which is a major relief. Mind it, no such marginal relief is made available to those who are opting for an old tax regime. One major relief which is given to given under the new tax regime is that in respect of surcharge. So in case your income exceeds 5 crore rupee, there is a surcharge of 37%. Basically, the surcharge starts from 50 lakhs rupees, 50 lakhs to 1 lakh, 1 crore, 1 crore to 2 crore, 2 to 5 crore. There are varying 10%, 15%, 25% surcharge on your tax. Surcharge is levied on your tax liability. So in case your income exceeds 5 crore, your surcharge on your tax is 37%. However, if you opt for new tax regime, that the maximum surcharge applicable to your income will be 25% and not 37%. And this is a major relief for those who are a high net worth individual and who are under a higher tax payers category. As I said, the new tax regime is the default tax regime. So if you fail to file your income tax return, I'm talking about the ITR which we will file for the current year in next year. So for the current year, the old tax regime is the default tax regime. But from current financial year, it is going to change. So in case you fail to file your income tax return by the due date, you will not have the option to have that old scheme for the current financial year, and for the return which we have to file for financial year 22, 23, the old tax regime will also only be available, and you will not have the option while filing your income tax return for new tax regime, which is, I said, will change. And from next year onwards, even if you have made investment under Section 80C, have bought a Mediclaim policy, contributed to NPS, etc., you will not be able to claim all those deductions, and you will have to invariably go to new tax regime. Though people who do not have business income are allowed to switch between one scheme to another scheme every year. So for those who do not have the business income, but the best course of action for them is to sit down while filing the return and calculate the respective tax liability under the old and the new tax regime, and choose the tax regime which offers you lower tax rate. However, those who have business income, those practicing doctors, or those doctors who are working as a consultant, they, once they have opted for a old scheme, they are allowed to come out of that scheme only once, and then you will not be able to opt for old tax regime again. However, in case the composition of your income changes and there is no business income for a particular year, then you can opt for opt between these two schemes. Lots of doctors engage in or indulge in share trading transactions, day trading transactions. So day trading transactions or share trading transactions are generally treated as a business income. So if you have a same day spread up some transactions, those profits or losses are treated as a speculative business income and get taxed under the business income. So howsoever small the amount may be, but that amount is taxable under the business income, and all the consequences of having a business income will follow. Like you will be able to make a choice of this scheme once only, and once you can come out of it, once you come out of it, you will not be allowed to again exercise that option. So this is the $1 million question. People ask which one is better. So as far as this is very difficult question to answer, and there is there can be no ready-made answer. However, as I said, for those salaried people, those doctors who are working as an employee in hospitals, even if you have exercised old tax regime, you can go for new tax regime while filing your return. So the option which you have exercised with your employer is for a limited purpose of tax deduction, and which you can reverse while filing your income tax return. And while filing your tax return, you can compute the respective tax liability under both the tax regime, and then decide while filing the tax return. The problem arises when you have a business income. So in case for those taxpayers who have their business income, their income below 7 lakh, the new tax regime is obviously better, because it gives you higher threshold for 87A rebate. For normally for HUF, we do not have much scope for making investments like PAP or life insurance policy or Mediclaim, etc. And for them it is, and since the salaried get the HRA and LTA, the question of such income accruing under HUF does not arise. So for them, the new tax regime is good. Those who are salaried and who are in receipt of HRA, LTA, have home loan, and are also making investment under Section 80C, have a Mediclaim policy, etc. The old tax regime looks better prima facie. But for those who are self-employed and do not have any home loan, the new tax regime is better than the old tax regime. Now we come to the presumptive scheme of taxation, which is applicable for professionals like chartered accountant, company secretary, engineers. It applies to doctors also. So there is a section under Income Tax Act 44 ADA, which gives the taxpayers, the professional taxpayer, a scheme based on the presumptive tax. So under the presumptive tax, the law presumes that certain percentage of your turnover or your gross receipt is your income. So 44 ADA provides that in case your gross receipts do not exceed 50 lakhs in a year, 50% of that will be treated as your income from your practice. And that 50% will be included in your income. This is applicable to individuals and partnership firm. So in case you have an LLP, you do not have the option to go for section 44 ADA, presumptive taxation. From the current year, a higher threshold limit of 75 lakh has been provided for in respect of those professionals whose the cash component of the gross receipt does not exceed 5%. And in such case, even if you those people who have a gross receipt up to 75 lakh rupees in a year can go for presumptive taxation scheme. And as I said, 50% of the gross receipt is treated as your income. If you claim, or if your actual income is less than 50% of your gross receipt, then the law does not mandate that you have to still pay 50%, a tax on 50%. But the section 44 ADA requires that in such case, you will have to maintain books of accounts and get them the accounts audited. As far as opting one presumptive scheme in during 1 year and opting out of it next year, it is possible. But the law requires that in case the receipt is less than 50 lakhs or 75 lakh from the current year, in case 5%, the cash component does not exceed 5%, you have to pay tax on 50% of the income. But if you claim that my actual income is less than 50%, then you have to get accounts audited. So between claiming lower than 50% and claiming 50%, you have the choice every year. So what happens in case your actual income is higher than 50%? So in case, if you opt for section 44 ADA presumptive taxation, you do not have to maintain books of accounts. So still, if from corroborative evidences, it becomes evident that your actual income is more than 50%, which may get manifested by investments made by you, or in case you maintain books of accounts and your actual books of accounts reveal a higher income, then in such case, you will have to show the higher income as your actual income, and you cannot go for 50% presumptive income. Now we come to the last part of the discussion, which is as regards maintenance of books of accounts by doctors. So the books of accounts are required to be maintained on the basis of method of accounting followed. The method of accounting has to be followed consistently year after year. The income tax laws allow two methods of accounting for those who are carrying on the business or those who have income from other sources. So as I discussed earlier, as far as the interest on bank FD is concerned, it gets taxed under the income from other sources. and you have the option either to show the interest income as and when you receive. Suppose you have made an FD for 5 years and you will receive the interest after 5 years. So your one option is that you can show the interest income when you actually, when the FD actually gets matured and you get the interest. The other option is that you show the interest on accrual basis, for which you can get a certificate from the bank year after year. So under the accrual basis, when you follow the accrual basis, which is called mercantile system of accounting, where you account for all your expenses and income on accrual basis as and when it happens, when your right to receive the income crystallizes, or when your liability to pay for certain expenses gets established. Whereas under the cash system of accounting, which is generally followed by all the professional, including chartered accountants and doctors, where the cash receipts are only treated as income, and expensive money which is paid is only treated as expenditure. So only these two systems of accounting are recognized under the Income Tax Act. Though there is the hybrid system which was practiced earlier, but since it is not recognized under the Income Tax Act law any longer, it is not followed now. Under the hybrid system, what one does is that the expenses are taken into account on accrual basis, but the income is recorded on a receipt basis. Now let us come to the requirement of maintenance of books of accounts. So Section 44A of Income Tax Act requires that all the practicing doctors, irrespective of the quantum of the gross receipt, have to maintain books of accounts. So the requirement applies to all those doctors who are practicing, whether they are full-time in practice or in part-time practice. This also applies to doctors who are working as a consultant in one hospital or more than one hospital. But in case you are on a payroll of a hospital where profession tax is deducted, provident fund, etc., is deducted, then the requirement of maintenance of books of accounts is not applicable to you. As I explained earlier, if you are indulging in day trading, which gets taxed under the business income, you are required to maintain books of accounts, even if you are salaried. The books of accounts plus the supporting documents are required to be maintained and preserved for 7 years, excluding the current year. So in addition to the current year, which began on 1st April 2023, you are supposed to maintain preserve the books of accounts of 7 earlier years as per the requirement of law. And in case you fail to maintain the books of accounts or preserve the bank books of accounts, there is a penalty of 25,000 rupees per year. I'm sure majority of the doctors will fall in the category of where the penalty is leviable, because nobody enforces the law. But I'm discussing what the law prescribes. So in case you do not maintain the books of account or you fail to preserve the books of accounts, 25,000 rupees is the penalty for each year of default. The rule 6F of the Income Tax Rules 1962 prescribes certain books of accounts which a doctor is required to maintain. So you are required to maintain cash book, where you have to enter all the cash and bank transactions. If you are following the mercantile system of accounting, then you have to maintain a journal book also, where the non-cash transactions are entered. The third book is a ledger book. In addition to these basic books of accounts, you are also required to maintain either carbon copies or counterfoil of all the bills issued to hospital or patients of more than 25 rupees. Additionally, you have to maintain either the original copy of the bill, and in case you have not received the copy of the bill, then receipt for payment in respect of services rendered. One specific requirement applicable to doctor is that the doctor is required to maintain a case register in a prescribed format, which requires you to enter the name of the patient, the nature of treatment given or services given, and the amount of fees collected from the patient with date. I'm sure nobody is maintaining such elaborate records, but this is the law. And in addition to this above documents, you are required to maintain the category-wise stock of drugs and medicine, etc., at the end of the year and at the beginning of the year. Next comes the audit requirement, when the doctor is required to get his accounts audited. So the first case we have already discussed, that in case your turnover is less than 50 lakhs or less than 75 lakhs, and if you claim that your income is below 50%, then you have to mandatorily get your accounts audited and submit the audited accounts on the upload the audited accounts on the income tax website by 31st August, which is 1 month prior to the due date of filing of the return. So in case your accounts are required to be audited, your due date of filing of return is 30th September. And in case your books of accounts are not required to be audited, then your due date for filing income tax return is 31st July every year. In case your turnover exceeds 50 lakhs or 75 lakhs, then every doctor has to get his books of accounts audited, irrespective of the percentage of profit, percentage of receipt which you offer for taxation. In case you do not get the accounts audited and fail to furnish the audit report to the income tax department via electronic uploading, a penalty of 0.5% of the turnover, subject to a maximum of 1.5 lakh, can be levied. That's it, what I wanted to share, or what I had to share. Any question, Dr. Pawan?
Sir, excellent presentation, sir.
Thank you,
I
sir.
think any questions, please post in the chat box.
I feel I've confused so much that there are no questions.
No, sir, it was nice one. I think any questions, dear participants? Yeah. Arun, sir, you can ask directly, sir.
Thank you. The first question was that for the people under 60, people above 60, do they get any extra benefit in the new scheme of taxation as vis-a-vis people under 60? Like in the previous old scheme, there was some extra benefits, like up to 3 lakhs, it was free, so you have a benefit. But yes, I believe in the new scheme, there is no change, no benefit for the.
Yes, because under the new scheme, the basic exemption limit itself has been raised to 3 lakh, which is otherwise applicable in case of a senior citizen under the old scheme. So,
okay, sir.
I don't think.
The next question was, if there is a long-term capital loss in a sale of property in a small amount, after indexation, if it comes to a capital loss, will that capital loss be offset against capital gains from mutual funds or shares in that particular year?
Yes, it can be set up. It can be set up.
And will that be
though the tax rates are different, but the basic nature of the income is the long-term capital gain or long-term capital loss.
And if the can that be also carried over to the next year, the capital loss?
So in case it does not get adjusted during the year against the long-term other long-term capital gain, then you are entitled to carry it forward to the next, I think, 8 years.
Okay, sir. And there's another small question. This issue of 50 lakhs, which is now raised to 75 lakhs under the presumptive scheme, like in the news, up to 75 lakh, they have that cash clause added. That is, a cash receipt shall not be more than 5%.
Yes.
So if it is still below 50 lakhs, then does that cash receipt clause apply?
No, no. So say the 50 lakhs applies to everybody, even if your 100% receipt is in cash.
Okay, sir. Okay,
But
sir.
in case the
Okay.
cash receipt do not exceed 5%, then you have a higher threshold for going for non-maintenance of books of accounts and opting for a presumptive taxation scheme.
Thank you, sir. Thank you very much.
Sir, Dr. Varadarajendra sir is asking like, is GST applicable for income from vaccinations?
Sorry, sir, GST is not my area or expertise, so I would not comment on it.
Okay, sir. Okay. Sir, Madhubalan sir is asking like, if you are using Tally, what other books of accounts need to be maintained?
So the tally maintained, and the tally you maintain regular books of accounts like cash register, journal, or ledger gets maintained. But in addition to those, you have to preserve those receipt book, the vouchers for payment made, plus copies of the carbon copies of the duplicate copies of the invoices which you have made. And I don't think Tally has the facility to maintain that case register, which I explained, giving the details of the name of the patient, nature of services rendered, and the fee received. So you have to maintain those records outside the Tally.
Any more questions? Please type in the chat box.
I had asked in the chat box also.
Yes, sir. Go ahead, sir.
Along with the market for presumptive taxation. So gains from the market are added for 44A. Am I audible?
Sir, if there are no more questions, we'll wind up, sir.
Thank you, sir.
Thank you, sir. Balwandin, sir. Thank you for sparing your valuable Sunday for educating all doctors regarding the taxation.
It was my pleasure, sir.
Thank you so much, sir. We are really grateful to you for that. And we'll share this video maybe 2 weeks later. Okay.
Yeah.
So thank you so much. Thanks a lot for all the participants for joining the session. Thank you.